Hello everybody and welcome back. Well, it's been a while since we've had such a monumental day coming on stock markets. The Federal Reserve will come out with their decision on what they're going to do with interest rates. Whether they raise them 50, 75 or even 100 basis points will have dramatic implications across stock markets, cryptos and commodities, and we'll be looking at that very soon in today's video. We've also got big gaps that have been left in the market, and of course a market that has now fallen over 10% on the Nasdaq from the top to the bottom. So what does this mean, and what do usually the 3 days after this occurs have in store for us? Well, it might surprise you, and there's a lot to go through in today's video. So sit back as we go through together all of the things that we're expecting over the next coming week. Stay tuned, guys. This will be a good one. See you soon. Well, welcome back everybody to the channel where we talk about stocks, commodities and cryptos daily. If any of those things interest you, of course, remember to subscribe and smash that like button if you find value in today's video. But let's get started by talking about the last 24 hours in the market. And you'll notice here, it was a mismatch. There were some things going up, some things going down, and it was trying to stabilize. That'll make sense when we look at the markets overall. It was tending to lean towards a little bit of risk on ahead of the big news, and we did have PPI coming out in the US, and markets moved off that slightly positively, then went negative. Strongest bull markets. Why are we in the situation like we are right now? Well, a lot of it was just the real ferocity of which this market took off. As you'll notice here, this is the 2020 stock market to current, and now we're in a technical bear market, but obviously the rally was the fastest on record since World War II, and it even surpassed things such as the run that happened from October 90 to March 2000 in terms of overall bull run. Will it continue to go up after? That time will tell, but it's a great, interesting chart to get started with today. So I mentioned before that 3 days after a market, things tend to happen. And this is taken from our private community. Someone shared it there. And of course, they've been trolling Twitter and finding this information, which is always good to have. And this is just a data statistic to do with when Nasdaq falls 10% in only a few days. So this is 3 to 4 days. When that occurs, what tends to happen 3 days later? Well, funnily enough, 73% of the time, the market tends to turn positive. Its average turn is around 2.1%. And of course, you can see some of the points here. There are some outliers that you could take into consideration, such as 87 and the flash crash that occurred there, and possibly wipe this particular stat off there. But as a raw data, generally markets that fall so quickly tend to move around. And this is consistent with some other things that we've seen. 4-day declines of 9% plus. Pretty rare, doesn't happen that often. This is from 1980 to 2022. What happens on the SP 500 after those points? The red dots detail these areas. And you'll notice that sometimes during, of course, things like the 2008 crash, we didn't rally, but we did tend to find lows through these areas. Sometimes it wasn't. Most of the time it was, and then we saw a turnaround in the subsequent days. That's consistent with the statistics that we're seeing right now. For consecutive 1% daily declines, such as we saw on the S&P 500, again denoted by these little red dots here, very rare, hasn't happened many times, and it does tend to show that the market might be in what we call fear or capitulation mode. Think about the media right now, even the title maybe of this particular video. Everyone's, of course, blasting you with a whole bunch of information, and that information is generally creating fear. And that is something that's stemming now through so many channels out there. Everyone's talking about markets again, and it tends to be that going back to that old Warren Buffett concept, when everybody's fearful, he potentially becomes greedy. Is it the time to do so? Data is starting to point that way, but as you know, we need to see the charts turning that way. Remember, patience, react, don't predict. Simple words, very difficult to pull off. So let's talk about the rate hike that's coming. Of course, we all expect a rate hike. The probability is actually increased, and the June probability of rate hikes now has gone up to 87% with a 75 basis point amount. And then of course, July, September, November, and December. By the end of the year, the current expectation, if all of these rate hikes came through, would be 275 in terms of basis point hikes. That's massive. I'm not sure if that'll happen. I still don't really believe that will occur, but it's still very big. Look at the changes that happened though over the last week in terms of expectations. We went from the 13th of May to having a fairly orderly rate hike. Basically 86% of people were in this range. Then all of a sudden, 1 week ago, it went to 96.1% of the economists out there believed this rate hike was going to happen. And then since we saw that inflation number, 99.7% of people believe that the Fed will rate hike up to 150 to 175 in terms of the current rate. So this is a massive change in sentiment. And this is a huge reason why the markets have, of course, fallen. If you want to look at the underlying, my belief is the biggest bit of news right now is China reopening. If they say, hey, we're going to scrap our COVID policy, or two, we've got some kind of vaccine or whatever it is, and they're going to open up the environment over in China and manufacturing comes online, remember that deals with a big portion of our supply problem here, which is partially what's causing so much inflation in these markets. Remember, the Fed control the demand by raising rates, but they cannot control the supply. That comes from other countries. And of course, the West especially is very dependent on other countries providing these main basic necessities really nowadays. Average stock distance from 52-week high, you'll notice it's a bloodbath across a lot of sectors, but there are some that are worse than others. Things like consumer discretionary have been hit incredibly hard, and that makes sense. Consumer discretionary is most susceptible to people having like a bit of a pour effect, like which happens when demand obviously drops, and also the supply issues have hit that area. You can see here technology also coming in behind. No news here, but it just shows you from 52-week highs how bad some of these sectors are in comparison to the overall market. So we have mentioned many times, I'm not going to go over this anymore, that US Treasury yields are very important. We like to see 50% of all US Treasury yields inverting, that is going backwards with each other. And when the bond market shows you that, every time since the 1970s, every time without fail, the bond market's been correct and a recession has happened. It actually hasn't happened just yet, but as we raise the short rate, so that is as the Fed actually gets closer to this 2-year and of course their expectations, because you've got to remember the Fed's very slow here. The 3-month yield can't invert because our current rate has never been so far behind what the market actually thinks the rate should be at. So will we get to a 50% yield invert? Well, that will be something that we'll watch on this channel. And remember to subscribe because we will be following that. Let's now get into the markets though. Let's talk about some technical analysis. Let's go into some accumulation, some strategies around the current markets and what we're seeing. So the VIX here, there's no question. Fear is still incredibly high. You can see it ahead of the news and ahead of all this big information coming out from the Fed. Of course, the VIX is going to be very high. But do remember there's more at stake than just the Fed this week. This is a quadruple witching event, which means that all the options are expiring as well coming into this Friday. We've got 4 major market option expirations. We'll be doing a video later on in the week talking about that once we see this Fed news get out of the way. In terms of things like really inflation, US 10-year is just continuing to spike higher and higher. I'm starting to see, as I said, and I'll update you here, the signs that this is peaking again. We got it correct over here. We obviously reverted on that idea at around this point and said, okay, yep, no, that was not going to work anymore, which was okay because of course we got that movement through. And at this point, I'm not quite convinced, but we're getting more and more convinced by the day that we might have just seen another spike high and the turn's coming. Keep updated on that one. We'll continue to follow it. Why is this important? Because once we understand how the yield goes, we can kind of get a bit of an idea on how the stock market is. So you'll notice here, here's the US 2-year, and then there's the SP 500. Now the SP 500 can only go up when yields are spiking like this if earnings, real earnings, are increasing as well and the economy is expanding. At this point, that's a big question mark. We don't even know whether some of these companies are actually earning more or whether with their revised earnings, they're actually going back. And that's a big portion why these yields are having such an effect on the stock market, the S&P 500, which we're following very closely. So do remember, if this turns, that is the 2-year starts to come down again, it really can coincide very heavily with the stock market bottoming and showing a good sign towards recovery. Think about over here. Think about what happened soon after that started dropping. We saw that recovery. Over here, think about what happened. It started stagnating. Then we saw a little bit of recovery. And as this grew up, it became more likely that there'll be a crash. So watch the 2-year very much. It's going to be super important moving forward. Dollar index, the US dollar cash, The run to safety has been the discussion. Cash is king, everyone says. Well, the US dollar has been rising here now through this crash on recent stock market days. And of course, in the crypto world, everything's falling apart as well. We'll take a look at that later. So where do things change? Well, I think this is a pretty important level here, which sits around this 104.63 on the Dixie or the DXY, the US dollar index. If we breach under that, we do what we call a first time frame change on the 1 hour. And this will probably show us that money is coming out of cash and going into stocks. That would be a good coinciding event with the market going up. If the market's going up and the dollar's going down, that can show you that money's going back into bonds, back into risk on assets such as stocks, and it's a good sign. Conversely to that, we might see gold also start to perform. So gold, we have two key levels that we've always looked at, 1830. We liked that previously. There was a good trade off it. This time round, it just came blitzing in and of course never changed trend. And now we're in a big demand zone. So I'll show you this on a daily just so everybody can see gold. It's basically flown down back down to this level, but gold hates yield. So what that means is that if interest rates go up, especially 10-year and 2-year, gold actually doesn't like that. So gold has gone down against this. Again, if you have US 10-year and 2-year dropping, gold can perform very well during those terms. Don't ask me to explain it right now. It's pretty complex, but that is something that is there. We're back into all these wicks, which means we're back into demand zone. And if gold's going to do well, it's going to set itself up here. So I could see it doing something like this, breaching 1830, pulling back. And at that point, we might start to get a little bit more bullish. It's in a demand zone. Some people will be bullish through here, but it hasn't quite shown the signs of turnaround. Remember, patience. React, don't predict. Let the market show you, the composite man or whatever you want to call it, let the market show you it's ready to go rather than trying to predict that future. Let's talk about predictions here in some ways for US oil. US oil's done the first time frame trend change. So what that means is it's made a new high, it's made a new peak, it's then come down, it's taken out to a degree some of the demand that was here through that 117.20 zone. It wicked it low. So if it now makes a new low, it's basically saying maybe this is the high. And if that is the high, then of course that will coincide a lot with things like yield as well. So we'll continue to watch the US oil story. For now, it's still kind of in an upward trend, but that little wick here has pretty significant ramifications for the market. You've got to remember it's making a series of higher peaks, higher troughs throughout this sequence. All of a sudden, it's technically broken down. Unless that was a sweep to steal liquidity and to grab in orders and take out stop losses, etc., it could have more dramatic ramifications. We'll continue to watch here. It's a very small time frame. We obviously want to see daily also get involved, and we'll find out when that happens. Let's move over to a couple of stocks. We'll just quickly talk about Tesla and Apple before getting into the indices. The reason we talk about Tesla Apple is a lot of you guys like it, but at the moment with the VIX so high, 30 plus, it pays to actually watch the SP500 and the Nasdaq and the Dow. And when they switch trend, then at the same time, you might want to jump into your favorite stock and say, okay, the market's going. Most likely, of course, the stocks will come with it. So here we have a long leg doji that shows us equilibrium or an equalization of orders, indecision, as many of you guys will know it as. And it's kind of around that previous demand area. If we breach here, notice the equal highs here on the daily, 680, one high, two highs. So if we're going down into the smaller timeframes, this will be pretty relevant, I think, for day traders. They'll come in, they'll see these wicks and they'll say, I want to see this thing change and go through here. And that's going to be a big, big thing. I already think that Tesla is stronger than the rest of the market right now. It's holding up pretty well considering around this zone, considering what happened with a lot of the other tech. So at this stage, 680 is a big deal. Then at that point, you could see it triggering. And of course, if it gets through this zone, back up we go to something around that 750. So Tesla improving, 620, a big, big level. If it breaks through that, well, yeah, it could be really bad. At that point, you're talking about 500s and a lot of people will be upset. Apple is similar, daily, long leg doji, not an equal high on the top. So you'll notice Apple is actually weaker in comparison to Tesla, because if Apple was the same strength, it would have come back up here. We'll watch and learn on this one. I think Apple will trade very similarly to the SPY. So in some ways, maybe the SPY is the better trade tool. Let's look at the DAX. So we'll look at some European markets. It's on demand, obviously sitting right on the level of previous defense. That is right here. One time it got bought up, two times it's got bought up, and it's at a critical zone ahead of, guess what? The Federal Reserve. Of course, the US does move every market in the world, at least the Western markets. So that's why we're at a critical demand level ahead with big gaps that are through this market as well. Let's move over to the Nasdaq and talk about big gaps. Nasdaq held up a little bit better than the SPY, the SP500, over the last 24 hours of trade. I think that's just due to a bit of rotation. We'll show you that in a second, but there are huge gap ranges here. And I want to talk about the Nasdaq by prefacing really this SPY, the SP500, and how we're setting up that at this stage. But if you think about it, let's just move over here to the futures market and we'll go down to the smaller time frames. What we're looking for is we're looking for this thing to actually show us that it's willing to change the trend. Because at this stage, I mean, bears are having a field day, just saying, yeah, I'm shorting, I'm shorting, I'm shorting, I'm shorting. Absolutely. But we know the data points towards this being a bit of a capitulation, possibly a very fearful sell-off that could switch just due to the data. So if we're thinking about technicals, where do we need it to get past? Well, you need it to take out these supply orders. There's a lot of supply sitting around that kind of 11.5 zone. I would expect that, considering the current sequencing that we're seeing, if we breach through here, we could have a pullback, but at that point, things to maybe start to turn towards filling some of the gaps that have been left on this market. Let's now have a look at XLY/XLP. So this is what we call consumer discretionary versus staples. They're two sectors in the market. It kind of shows us risk on and risk off in terms of sector rotation. And it's one of my lead indicators to figuring out how the market's rotating. Notice it's been a horror year for risk. The whole time, ever since November last year, it's been really bad. Things have changed though recently. We've had new lows on the market, yet this particular indicator has shown to hold up a little bit better. And what that's showing you is that the market is actually rotating a little bit out of some of those inflation plays. You can kind of tell on the charts that's what they're doing. And they're moving into a little bit of risk. Now, it doesn't mean that we're in the bottom, but comparatively, it's holding up a little bit better. Interesting, and certainly worth continuing to watch. S&P 500, this is where everything really comes back to. The big market in the world, whether you trade crypto, whether you trade commodities, whether you trade anything else, this thing matters. Even if you're trading the ASX 200 and you're in Australia, or the FTSE or the DAX or whatever, this will push the market to a degree. We've got two massive gaps. Now, a lot of people see this as potentially an inefficiency or something like that, where the market must come up and fill. Gaps don't have to fill, but it certainly is a very brutalized market here. And something that goes this fast often likes to come back. And it comes back usually to what we call mean reversion. That's the 20 moving average. So if we add a moving average here, and we'll just use a standard one, a SMA rather than an exponential, and you add a 20 on here. So we'll go 20, pop that in, and then we'll just add this as a red market. We'll make it a little bit thicker so it's there. What you'll notice is it's quite far away from the 20 SMA. The market likes to revert back to this zone because it's just the natural formation of markets as they go down. They go up, they go down, they go up, they go down, they go up, and they kind of like to sit around this level and come back eventually. Mean reversion is a thing. Of course, that's why it's included in something like a Bollinger. And speaking of Bollingers, if you add a Bollinger onto the S&P 500 right now, you'll notice there's the 20 in the middle. And where are we? We're outside of the Bollinger. So that means we're in an extreme zone ahead of extreme news. Markets are in fear capitulation. Often when the Bollinger gets breached, and of course it can come down further, this is where you get those really fierce reactions in markets. Volatility goes up and day traders come in to try to trade around the news, see the traps and react to it. Again, patience, react, don't predict as much as possible, guys. It makes a huge difference. And I think it's a big thing that it's a little bit different on this channel than a lot of YouTube. So again, I'd say subscribe because we will, of course, talk about this more in the future. What's an important level? No doubt this 3820 is a big zone. 3800 to 3820. This is where we opened up in the Monday session. We did the live talking about it. There's so many orders that are most likely around here and a big supply that was previously demand. we breach that, all of a sudden things start to change and we move into potentially filling these gaps. So it's a very important zone, of course. Follow your own system, follow your own concept. This is not telling you to buy or do anything like that, but it's just an interesting area from a technical perspective that is most likely holding some form of orders in this market. Let's move over to the futures just to see how it's reacting here. You'll notice at the time of recording, we've still got that order. That's that 38.20, 38.10 zone. You'll notice it's made a new low. As it comes up to the news event, possibly it might rally into this resistance, or maybe it might even be down at demand. Once the alert comes out, that is whatever the Fed choose to say, don't be surprised at all to see the market go against whatever you think it's going to do. Remember, you do not have the information. And one thing you certainly don't know is how much of the Fed's result is packed into this current decline. That's one thing we can't figure out. There are forces at work here outside of your or even mine understanding. Basically what that means is that we have a quadruple witching event with huge manipulation due to options. We have a massive news announcement with a huge amount of basis points that's already, in many ways, the market's already 90 crazy percent of people expect it to be big. And unless it's outside of that, markets could rally. Think about some of the previous FOMC events and what markets have done. They've actually gone up off the announcement. Now, again, predicting that, it's not really what you're about. You're about reacting to that ideally. So hopefully you'll be able to navigate those results. Let's talk about max Payne. You'll notice here 391, so we're a little bit underneath that. And on the 17th, we've still got a huge reading here, 418 in terms of if all the options expired. This basically means that if Wall Street was to make the most amount of money possible, there would be option expiration at around 418 on the SPY. That's probably not going to happen this week. We all know that. However, there could be some severe manipulation coming into this quadruple witching. So watch out for this one. Let's move over to Bitcoin. Bitcoin still looks pretty terrible. 22,000 obviously took a monstrous dive. We're starting to structure up a little bit on the small time frames, but you've got to be very careful here if you're trying to take long, unless you have some longer term plan, because day traders can get brutalized in this. Most likely the orders sit somewhere around here, this 24,000, where it previously wicked off, and everything in here is most likely noise at this stage. So I like with crypto to watch it structure up. It can do so and then make the next move. If you think about BTC versus Ethereum as well, big breakout here in the last 24 hours. Really what this is, well, last 2 days, what this is showing you is that effectively Bitcoin is now in command. And this happens a lot during crypto winters and declines. For a long time, let's say over here, we saw alts really come through. That's where the FOMO enters the crypto market. This is BTC versus Ethereum. Then after that, after you go into crypto winter, as a ratio, Bitcoin becomes much stronger versus Ethereum. So it's kind of been in a base now. Of course, we saw at the back of 2020 into 21, we had that really big movement into alts, and alts all started to do incredibly well. And Bitcoin kind of floundered in some ways. Right now, Bitcoin is kind of controlling this market because it's the safest coin from people's expectation. And that's why it's there. If you haven't already, come and follow us over on Twitter, or of course, join us in our Discord community. We have a public and a private Discord community. You can join the free 7-day free trial if you're interested as well. We do pre-market streams there and all sorts of good stuff with the shares. And as you know, there's big information coming out. Core retail sales 1 hour before the market opens. That'll be interesting, I'm sure. Expectations aren't that great. And then, of course, we have the funds rate. You'll notice here about 1.5%, though that should update. It's probably a little bit higher now. Between 1.5 and 1.75 is the new expectation. Then we've got a whole bunch of extra information coming out from CHF, and of course, UK, Bank of Japan as well, press conference. And then we've got Fed Chair Powell speaking on Friday. It is an action-packed week worth of news. You've got to be careful out there. Yes, the trend is currently still down. The data would say that that was an extreme move. Let's find out what happens over the next 24 hours. And of course, always try to go in with a plan. And if you're confused or you don't know, what's the harm of staying out of the market? Yeah, and just protecting yourself and protecting your hard-earned money. Thanks so much, guys. Remember to subscribe, smash that like button, and we'll see you in the next one. Bye for now.